Greetings and welcome to ROI Clear. My name is Ray Hightower, and today we are fortunate to have as our guest Mr. David Frasz. David is Director of Nationwide Multifamily Direct Lending at Lument, and we're looking forward to speaking with him about multifamily lending, about business challenges, how he leads his team, all of those things that business leaders think about as we conduct business and as we lead our teams. So without any further delay, please join me in welcoming David Frasz. David, welcome.
Ray, thanks for having me on. Happy to be on.
Very glad to have you here. And David, to kick things off, we're going to start off with an elevator pitch. And for those who are new to ROI Clear, David is on an elevator with someone he wants to influence. So David, we're going to ask you, what would you say to that person in the course of an elevator ride?
Sure. Well, it depends on the size of the building, but I am a commercial loan originator for a top nationwide commercial real estate lender. I'm responsible for relationship management and financing all asset types, but specifically multifamily financing through Fannie Mae, Freddie Mac is my specialty. We also offer FHA, HUD loans, bridge loans, and we do multifamily assets as well, like industrial and office and retail, hospitality. I'm acutely focused on building relationships, so that's kind of where I spend most of my time and working with my clients to achieve their investment goals. I've over about 10 years, I've built a reputation for client services and built a track record that demonstrates an ability to get deals done, even in the most difficult situations. And even situations where my competitors have said the deal can't be done.
So when somebody says that it couldn't be done, that is something that you're in a position to tack as a direct lender.
Yes, exactly. Well, I've had many situations where a borrower, a broker comes to me. They've had a loan fall out in 1, 2, 3 other places, and they're just really what becomes clear is that the people that are working on their behalf, whether it's the broker or whether it's the lenders that are taking the deal in, they're not putting the time in to really understand the situation or explore creative financing solutions. And the reality is how you craft the loan narrative, how you put the pieces together, who you bring onto the borrower team. All of those things matter as far as getting a deal through credit committee. And I started my career as an underwriter, so I've been using those skills ever since to get deals done.
You started off as an underwriter. So you've been in the business 10 years. Your first few years were in underwriting, or how does that break out?
Yep. Yeah, I started off pretty green. I was in essentially in investment banking of sorts. I worked for a couple of large investment banks prior to getting into real estate, still early in my career. And I started off on a screening team. So I saw hundreds and hundreds of deals over the course of about a year, learning from those above me and around me how to screen deals and understand what I'm looking at in financial statements and rent rolls and offering packages and what questions to ask, and really putting a deal under application. So that was kind of how I spent the first year, and sort of also started brokering deals at that time, when I just got really into real estate and I was talking to everybody about it, and I started using my skills as soon as I could add value to owners and borrowers. I started working with them on their loans, and then I moved into underwriting, which is more of the processing part of the loan, where loans under application would come to me, and I would have to dig into the zoning, dig into the the flood zone, and obviously deep dive into the financials and that sort of thing, and really put the whole package together, get the diligence from the borrower, and put a narrative together to get it through credit committee. And so I did that for about 3 years, and then I was building relationships and brokering, and I decided to make the move into direct originations full time, and I've been doing that ever since.
Excellent. So you started off as an investment banker, underwriter, and now loan originator. That's a fascinating background. And what's really interesting is each stage in your career uh, gives you a foundation for subsequent stages, and that's remarkable. All of that makes you puts you in the position where you are today. A
Yeah.
question I would ask you is this: you and I are on opposite sides of the table when it comes. I'm an operator, syndicator, and you're there as the lender, and we always want to partner together and work well together. At the same time, some of my colleagues, they'll say, "Oh, my deal fell out. Now I need to find a lender." Why is it, in your experience, what are some common reasons that deals fall out of lending, and what can we as operators and syndicators do to prevent that from happening? How do we make things easier for people
Sure.
like you, really, is the question.
Sure. Yeah. So I have two main points on that question. The first is that it may seem like we're on opposite sides of the table, and
Mm,
a lot of people do approach their lender in that way, as if you need to shield them from certain things or not tell them certain things or only give them what they ask for. And
mm,
I can't speak for every lender. I'm sure that that's the case. I'm sure there are credit oriented lenders that are looking for ways to decline a deal to make their business easier or more streamlined or what have you. But
mm,
someone like myself, with the underwriting background and with the ability to help you creatively structure your deals or find solutions to complex problems within your deals, you really need to work with someone like myself as a part of your team. Your
mhm,
lender, your attorney, your insurance agent, your um, you know really anybody that you bring on a team. You don't shield things from your property manager. You don't shield things from your attorney. You let them help you, and by giving them that power to be your mentor, your guide, your partner in the loan process, you make it a lot more likely that you're going to get over any hump that comes up. The second piece I would say is the a lot of deals fall through, in my opinion. What I've experienced is a lot of deals fall through because they're not properly vetted up front, and
mm,
it's a tough position for both borrower and lender, especially when you don't know each other very well, or if you're working through a broker who may be sending the deal to multiple different lenders. There's often a tendency for the lender to put out the best terms that they are hopeful to achieve, or not ask all the questions that they might otherwise ask up front because they don't want the broker or the borrower to think, oh, this is too much, they're asking for too much, or this is going to be a pain in the butt or whatever. The reality is, most times all of those questions will come up at some point in the loan process.
mhm,
All of the requested information that someone like myself might request up front will be requested later on. And on the off chance that I'm requesting something up front that may not be requested later on, it's to give me the full picture of the deal and let me really put all the pieces of the puzzle together
yeah,
and use them as like a deal board, or you see those crime movies where they've got faces all over the whiteboard.
yeah,
You let me have all the pieces and I'll figure out how to best get the deal done. And I think a lot of times information that is critical, whether it's a prior bankruptcy or pending litigation, or a business that went sideways, or prior foreclosures or credit blemishes, or people say that their credit is in the 700s, and we bring in a deal and it's actually 670 or something like
mhm,
that, falls below a minimum. um, things like that, or saying, yeah, we've got prior experience, but what kind of experience? If you don't give me a full schedule of real estate, I don't know if you've just owned a couple of single family rentals or an Airbnb,
Hmm.
and I can't pass that off as a multifamily experience.
Right.
So really just treating your lender as a part of your team. And if you've got something that's likely to come up or something that's unique about the deal or your situation, have those conversations up front, because I think that's the number one reason why deals fall through.
Right. Right. Wow. Include everything on the SREO, the schedule of real estate owned, so that they have, so that the people that you're passing the information on to have an idea of what the experience is of the team. And you don't expect everybody on the team to have all the experience, but because that's why we have a team. And you, rather than seeing the operator and the lender, or the operator and the broker, or whoever's on different sides of the table, rather than seeing them as being on opposite sides of the table, we're really on the same team and we want to get a deal done.
Right. Yeah, and I can't speak for necessarily how every bank does that, because I believe some banks you work with a branch manager or a loan officer, and they basically help you with your intake form, and then from then on you're passed off to the underwriter. But uh, in most of commercial real estate lending, there's going to be a loan originator like myself, and that's
Mm-hmm.
generally a commission based um, uh, employee of the lenders. So they do work for the lender, but they also get paid by getting deals done. And
Mm-hmm.
the goal, my goal, is to figure out how to get deals done, how to make deals fit in the box that they need to fit in, so we get them done. And that's ultimately the same goal as the borrower has as well. So nobody's
Yeah.
trying to pull one over on anyone else. We're just working together. And I think there are a slew of reasons that deals fall through. But I think it all kind of comes back to just lack of transparency up front.
Yeah. All right. Bad news does not get better with time.
Right. And I
Yeah.
tell you from experience, there are a lot of borrowers. I mean, I still deal with them on a regular basis, where you send them a list of questions because the deal is on the margins, or there are things that could be potential pitfalls. Maybe they won't at all,
Mm-hmm.
but you send them a list of questions, and they just see your list of questions as an obstacle, and oh, it's going to be too much work. And
Mm.
the reality is, this is commercial real estate. We're lending millions of dollars. And if you want a loan, sometimes you have to roll up your sleeves and, answer questions that might take you 30 minutes in an evening to go through
Mm.
a list of questions. And it's not just, hey, I want a loan. I'm buying a property, so give me the money. It doesn't work that way. And it's a point of tension and frustration between all lenders and borrowers and brokers to get the information. And one thing I've done in my career is I ask for all that information up front. And if you're
Mm-hmm.
not willing to provide it up front, then it's probably going to be like pulling teeth to get it during the loan process. And
Yeah.
I don't want to spend my time working on a deal that ultimately dies because of lack of transparency. So it really works in everyone's best interest to kind of play ball. And unfortunately, there are just some people that want it to be easy peasy the whole way, and don't
Right.
want to lift a finger, and that usually doesn't bode well for the transaction.
Right. Be transparent up front so we can go ahead and solve those problems. Makes sense. Makes
Right.
sense. You do Freddie and Fannie loans. And, in our business, many times those terms are used interchangeably. Are there things we need to know about the differences between Freddie and Fannie before we apply through a firm like yours? And are there things that we could do differently when applying for a Freddie or Fannie loan, or some other type of loan that would help you to do your part of the job more effectively?
Yeah, so in general, I wouldn't say that you as the borrower need to know which program is best, but it is important for you to understand a little bit about the differences, because
Mm-hmm.
there are lenders out there, competitors of mine, where they generally will just quote the lowest rate loan option because they know that borrowers that aren't well versed in commercial real estate financing aren't going to necessarily know the quality of the loan that they're getting is actually lower, and that's why they're getting a lower rate. So some of the differences to key in on: Fannie and Freddie, they determine their markets differently. And when I say their markets, I mean, whether it's an 80% LTV market or a 65 LTV market, or a no-go market or whatever, right? So they look at markets differently. Freddie Mac uses the county, at least on the small balance side. They use the county to determine the size of the market, and they tier them by small, very small, standard markets, and then top markets would be your New York, your DC, your Boston, your Miami, your San Francisco, even the Dallas County is a top market for Freddie Mac small balance. Fannie Mae, on the other hand, they don't really have a rhyme or reason. So you could be in a small market, population-wise, but it's still considered one of their what they call nationwide standard markets. And so different, whether it's Fannie or Freddie, it may be, just because it's in a small market, for example, doesn't mean that you're going to want to go Freddie Mac because the terms are better or something like that. It could mean that it might be a small market with Freddie Mac, but a standard market with Fannie Mae, and so you might get better terms with Fannie Mae. So there are differences there. There are also differences in the loan structures, which we can go into in depth, but essentially the way they price their loans is different. Fannie Mae, it's usually a kind of an investor, what we call an investor spread, which is just a Wall Street, bank, let's say. There's a spread over an index, and the index is typically the Treasury. So that fluctuates with market. It moves day to day. Freddie Mac, they issue their rates on the small balance side kind of based on a grid, which they do update periodically, whether it's once a week or a couple times a month. But essentially it's fixed at that grid with adders and subtractors based on how you structure the loan. Freddie Mac on the conventional side is kind of a black box. You have to go in and request pricing on a deal, and they'll tell you what they want the pricing to be based on how they view the risk and how much they want the business. So, prepayment structures, interest only, all of those different terms are slightly different the way they're determined with Fannie and Freddie. So again, I wouldn't necessarily say the borrower needs to know all of that, but you should be aware there are differences. And if you're working with a lender that isn't offering up an explanation for those differences and why they might have quoted you one loan product versus another, you should be asking, why not Freddie Mac or why not Fannie Mae? I got the question just recently that was just like that. And the answer was, well, you want declining prepayment. And if we're going to do declining prepayment with Fannie Mae, it's going to be, the rate's going to be much, much higher, and it won't make sense for your deal. So simple questions like that will make sure that you and your lender are on the same page. The other thing is just be very clear with your lender about your business plan. If you're going to refinance in 2 to 3 years, let them know that. If you're going to hold the property for 10 years, let them know that. If you may sell the property in 2 years or 5 years or 7 years, let them know that. Because structuring a loan, there's much more to it than just giving you the lowest rate. And you don't want to end up in a loan that makes it very expensive to get out of in 2, 3, 5, 7 years.
Yes. Oh my goodness. I'm thinking of friends of mine who had to pay. I think of multiple instances of operators who had to pay a rather large defeasance fee in more than one case. It turns out that selling the property and paying the fee, in some cases 6 or 7 figure defeasance fees, it made sense. Then they were still able to deliver amazing returns to their investors. But if you can avoid that, you want to avoid that. And then sometimes if there, well, you can tell me, I would imagine that there's some cases where if all of the products are calculating yield maintenance or defeasance in the same way, you don't really have a choice. If all the products are calculating that way, you have to bite the bullet. Or am I seeing things wrong?
Nope, you're correct. But there are other options.
Yes.
So the standard kind of tug of war is between a yield maintenance or defeasance
Mm-hmm.
and what we call a declining prepayment or a step down prepayment, which might be
Mm-hmm.
a 5 4 3 2 1 structure or something where
Mm-hmm.
you the first year, if you were to prepay the loan and pay it off in the first year, you'd pay 5% of the unpaid balance, whereas in the next year you'd pay 4% and so on and so forth. So the challenge with that, not the challenge, but where borrowers get tripped up and they end up in loans that they don't like and they don't want to be in, and they find that out when they want to refi or sell,
Mm-hmm.
is again, a lot of borrowers get into a yield maintenance loan when they go to a lender and they say, no, I got to have the lowest rate. It's got to be, you got to beat this rate. And so the lender or the broker says, well, the only way I'm going to get business, the only way I'm going to put food on my table is by giving you a rate that's below whatever, 5% or whatever the
Mm-hmm.
number is that the borrower wants. And so they quote them, they basically give the borrower what they want, but they
Mm-hmm.
don't advise the borrower because it would be to their detriment, that the loan you're getting is not going to be friendly for you in 3 years, 4 years, 5 years. Because the reality is, if you want a better loan, if you want a more flexible prepayment structure, you have to pay for it.
Mm-hmm.
And if that differential is between 50 to 100 basis points different, you may still choose the yield maintenance, but at least you've chosen it. But if you choose declining prepayment, one thing that I pitch about the declining prepayment is it's a known quantity. You know what your
Mm.
prepayment is going to be in each year. And in this
Sure.
business, certainty sometimes is undervalued, but it is very, very valuable. And
Mm-hmm.
if you do a 7-year loan and you know that your prepayment in year 5 is going to be 3%,
Mm-hmm.
um, that's a lot better than doing a 7-year loan and maybe your prepayment comes in at 6% or 8%, or you do yield maintenance on a 10-year loan and your prepayment could be 12, 13, 14% of your unpaid balance if you
Mm-hmm.
if you choose to sell or refinance after a few years. So again, it's important to understand the business plan, because if you're going to be adding a lot of value and you're going to want to refinance or sell, you really need to consider paying for a better loan that's going to give you that certainty and that flexibility down
Right.
the road.
Right. Right. Yeah, it's about the structure. You're going to pay earlier or later. The key is to choose a product and choose it on purpose, something that fits your business plan.
Right, exactly. And if you're doing a yield maintenance loan in that's contrary to what makes sense for your business plan, and you're doing it because the deal only works at a rate below X,
Oh,
then what
yeah.
that tells me is that you're choosing your loan that's going to bite you down the road just because it's the only loan that makes the deal work, which tells me that there's probably not enough uh, room in that deal, to be honest.
Yeah.
And I have to be gentle when I say those things to borrowers, but the reality is, again, look at me as your mentor, your guide, your counsel. If you don't like it and you go against it, that's fine, but don't make me the the bad guy for giving you the honest assessment of which structure makes the most sense, or what doesn't fit or does fit with your business plan. So it's just really important to flesh that out. And I think that is, as an investor, there's a level of kind of maturity as an investor that comes
Mm-hmm.
along with that. And if you can do that and say, what, the deal only works below 5%, but it's really going to bite us and we're not going to know what our prepay is in 4 or 5 years. that's an important thing to be able to make a decision on and walk away or proceed. But
Mm-hmm.
at least you know what the calculations are.
Right. Sometimes you have to walk away. And no, you're not the bad guy. You are Obi-Wan Kenobi. And you have the beard to prove
That's
it.
right.
This is fascinating to me. And listening to you talk, I'm seeing so much more. I'm seeing so many lender conversations that I've had over the years. I'm seeing so many lender conversations in a more positive light now, listening to you, because I'm thinking about the challenges you have to face. You're thinking about, last thing you want to do is take a property back. Well, that's a drastic step, right?
Yeah.
But the last thing you want to deal with a property where the numbers aren't working and your customer is struggling to make the debt service payments. Well, nobody's happy about that, because you want customers, you want borrowers that want to come back to you for the next deal and the next deal and the next
Right.
deal. And that ties into your whole, you mentioned earlier at the beginning of the call about your relationship building. If you're building a relationship with someone, you want them to have the best product that fits their business plan. There we go again. That's why you want to understand the operator's business plan up front, because
Yep.
not every product is going to fit every business plan.
Yep.
If they know they're going to do an exit in 2 or 3 years, you don't want to give them something that's geared towards a 7 or 8 year exit, because they're going to pay a pretty big prepayment penalty.
Right.
You don't want to have to deal with that. Right.
And there again, though, there are kind of two sides of the same coin. Are, as an investor, you also need to be careful what you say to your broker and lender, in the sense that you don't want to just say, yeah, I need the lowest rate. Absolutely. Get me a rate below 5% or whatever the number is.
Yeah.
Because that broker is then going to try to find you a loan below 5%, or they're not getting paid. And the same thing with the lender. And so you need to make sure that you're showing the lender, the broker, whoever you happen to be working with, that you're open to the best possible terms to fit the business plan. And
Right.
you have to have that level of maturity as an investor to know that what fits your business plan best may not be the lowest rate. And that's a challenge, because sometimes the rate differential is substantial, and sometimes it affects the numbers on the deal. But
Yeah.
if you're going to do a yield maintenance loan, for example, and then you're going to only budget 3% prepayment penalty in 4 years, well, you're not actually underwriting the deal properly. If you're going to do a yield maintenance structure and you're going to take the lower rate today, then you might want to pencil in 8-9% prepayment on your exit. So you can do either, and you can run the numbers on both scenarios. But if you're going to do those scenarios, you need to do them accurately. The second side of that coin is essentially the lender. It's incumbent upon the lender to ask you the right questions. And if your lender is giving you quotes without asking you questions about your business plan, or asking you how long you might hold the loan, or how long you might own the property, or if you have a sale or a refi that you're planning on, if they haven't asked those questions and you haven't told them, then they're just giving you kind of a run-of-the-mill quote, and they're not really necessarily giving you loan options that are going to fit your business plan. So you got to be aware of that as well. And it's not necessarily their fault. They may just be busy, or they may have picked up on something you said and thought you just wanted the 10-year with yield maintenance. But if they haven't asked those questions, then they're doing both of you a disservice. So and I have clients right now that are relationships of mine, that they did their first Fannie or Freddie loan with a different lender years ago, and they just put them in a yield maintenance prepay, didn't explain it. They got bit really hard on a prepayment penalty, or maybe they're still holding a property because it had such a high prepayment. and they didn't like that, and so now they work with me because they know that they're always going to get those questions. They're always going to have that discussion about what's best for them.
Right, right. Yeah, otherwise that's going to a dentist that wants to drill without doing x-rays first or examining first. Right.
Exactly, that's a very good analogy.
Yeah.
Right.
This is fascinating. Man, David, we're coming towards the end. This has gone really quickly. I have so many more questions, but we want to respect your time and the time of our listeners. And I'm grateful for all of your answers. As we wrap up here, let me ask you, what is it that you're reading, or what do you recommend that our listening audience read or listen to? It could be an audiobook or a paper book or Kindle, what have you. What are you reading
Yeah.
right
Yeah, I mean, good question. I think I'm actually interested in hearing what you might be reading these days, because I've been so busy, I haven't been able to pick up a book in the last few months. But
now? Wow.
my recommendation, just depending on the level that someone is at, but if you're looking to kind of grow as an entrepreneur and think strategically about your business, a couple of books come to mind, and that would be Built to Last, Blue
Mm,
Ocean Strategy, and a book called What They Don't Teach You at Harvard Business School. Um, and I would definitely recommend those if you're an entrepreneur and thinking about your business. Of course, one book just to frame the way you look at money and the way you look at investing, I think is required reading for anyone that wants to become wealthy, is The Richest Man in Babylon, which is also a
mm.
very, very easy and entertaining read as well.
Thank you for those. We'll make sure we include links in the show notes. Grateful to you for those, David. And then how do people get in touch with you?
Um, you can get in touch with me, just to connect if you'd like, on Instagram or LinkedIn. Of course, I'm in the business of being on the phone fairly often, so I'll always take a cold call. Never hesitate to reach out, leave a voicemail if I don't get to you, because I am on the phone a lot. So I'll call you back. And of course, if you have a deal and you have related materials to send over, um, certainly don't text that stuff over, because I need to do analysis on a computer. So
Mhm.
send me an email, and I can give that information here, or if you want to put it in the notes, that's fine.
Yes. Okay. Very good. Yep. Yep. We'll make sure we include that in the notes. If you want to recite the phone number for those of us who are, those of our listeners who are listening in the car, I don't know if you want to share that with us.
Sure.
Your
Yeah.
phone number.
You can get me 857-236-3000.
Wonderful. And a URL on the web.
Yeah, I mean, on LinkedIn, it should just be David Frasz. Yeah,
Okay.
I'm
Got
not
it.
sure
We'll
exactly what it
include a
is. I
link.
think it's
Yeah.
David hyphen Frasz or something like that.
We will include the links. That's what we'll do.
Great.
All right. David, thank you so much. It's been a pleasure having you here at ROI Clear. Rich conversation. Lots of good learning. Thank you for sharing with us
Yeah, thank
today.
you. Thanks for having me on.